Hi, welcome to today's video. My name is Shadow Kopoko Frempong, and today we'll be looking at stakeholders or users of the financial statement. So, stakeholders are individuals or group of individuals that have interest in what the organization does. It is important to know that the interest these individuals or groups have in an organization may be direct or indirect interest. Now, these individuals or groups are made up of the management of the organization, the employees and their trade union representatives, auditors, the public, customers of the company, the suppliers of the company, lenders, and government agencies or regulators. Now, we'll be looking at who these guys are and what their information needs are. So, when it comes to management, these are the internal team responsible for running the business, and they need the accounting information or the information containing the financial statement to make their decision, to plan and also control the expenditure, and finally to evaluate their performance. So the financial statement will be one of the best documents to provide them with financial information that will be used for making their planning, decision making, and also evaluating their performance. Two, employees and their trade union representatives. So employees are the staff or the labor force of the company, and they are interested in profitability, job security, and company stability. Of course, if the company is making profit, then the company will pay them and pay them well, so there is a job security. And if the company is in a stable position, then it provides a prospect for career development. Three, auditors. So we are looking at both the internal and external independent parties, which are the auditors, to verify the financial statement or the accounting records. So they need the accounting information to determine whether the company is actually complying with accounting standards or industry regulations. When it comes to the public, this refers to the local community in which the company operates, and they are more focusing on the relationship between the entity's profit as well as how much the company has invested in the community in the form of corporate social responsibility. When it comes to the government agencies or regulators, we are looking at the tax authority, industry regulator, or any other government agency. So they need a financial statement or accounting information to check compliance with tax laws and other regulations, look at proper disclosure of accounting information, and also industry specific reporting requirements. This one doesn't relate to all organizations, it depends on the industry in which you find yourself. If your industry is a highly regulated industry, then this may apply to you. So that has to do with the banks, the pension company, and the others. When it comes to customers, these are the buyers of the company's goods or services, and they will need a financial statement or accounting information to assess the financial stability of the company to ensure consistent supply of goods or services and also any long-term viability for maintaining business relationship. The truth is that no one is interested in doing business with a company who may be going out of business very soon. So they would like to assess your financial stability and be able to know, okay, this company will be in going concern, so I can actually rely on them and start buying their product. Lenders. So this refers to banks, financial institutions, or even suppliers providing credit. They include both short-term and long-term lenders, right? And they are interested in the company's credit worthiness and long-term solvency. Of course, they don't want to give you money and the following day they would hear you are out of business, or they give you money and you might not be able to pay. They will also lose at their end. So they will definitely obtain your accounting information or your financial statement to determine if you'll be able to pay just in case they give you funds. The next one has to do with suppliers. So suppliers are providers of goods or services on credit terms. So they use your accounting information or the information contained in your financial statement to assess your credit worthiness and also your ability to pay on time. So they will use the information contained in the financial statement to assess your credit worthiness, your ability to pay on time, your financial stability, so that they would be able to also make decisions as to whether to sign a long-term agreement with you or even to sell to you on credit, right? Your accounting information is really important to them. So it is important to know that in as much as they are all stakeholders, they may have different information needs, even though they have interest in the organization. So in the case of an investor, these are people who provide funds for us to do business, providers of funds. And they will be concerned about the profitability of the business and also our ability to pay them their expected returns. So yes, they are all stakeholders, but they all have different interests and different information needs. It gets to a point where the interest of these different stakeholders might conflict. So an example has to do with an investor or a shareholder who wants the company to cut down their expenditure so that they can receive a higher returns. Whilst employees of the company also expect their salary to be increased, which will definitely increase the expenditure or the expenses of the business. And by so doing, the investor or the shareholder is going to receive a lesser return. So there are conflicts between the interest of these stakeholders, and management have to find a way of resolving this conflict. Thank you for watching, and I'll see you in the next video. Have a nice day.